On behalf of Nomura, I would like to thank the management of Happiest Minds for giving us the opportunity to host this earnings call. Today we have with us Mr. Ashok Soota, Executive Chairman, Mr. Joseph Anantharaju, Vice Chairman, President and CEO of PS, Mr. Rajiv Shah, President and CEO of DBS, Mr. Ram Mohan, President and CEO of IMSS, Mr. Venkat, Managing Director and Chief Financial Officer, Mr. Aurobindo Nanda, who's the President of Operations and Deputy CEO of PS, Mr. Praveen, who's the Company Secretary and Compliance Officer, and Mr. Sunil Gujjar, Head of Investor Relations. I will now like to hand over the call to Sunil for safe harbor statements and to take the proceedings forward. Thank you, and over to you, Sunil.
Thank you, Rishit. Very good morning to all. Welcome to this conference call to discuss the financial results for the third quarter ended December 31st, 2020. We trust all of you are keeping well and staying safe. I am Sunil from the Investor Relations team. Ashok and Venkat will begin the call with a brief overview of the company's Qtr3 performance, after which we will have the floor open for Q&A. Before I hand over, let me begin with the safe harbor statement. During the call, we could make forward-looking statements. These statements are considering the environment we see as of today and obviously carry a risk in terms of uncertainty, because of which the actual results could be different as outlined in the earnings release, which is available on our website. We do not undertake to update those statements periodically. Now, let me pass it on to Ashok. Over to you, Ashok.
Yeah. Thank you, Sunil. Good morning, ladies and gentlemen. I'd also like to begin by thanking Nomura for hosting this call. And I'd like to welcome all of you to the conference that we are having for our financial results for the quarter ending December 2020. As you know, this is the second quarter after our IPO, and we would like to thank the financial community for the support that we have received. I am really happy to say that Happiest Minds has delivered an excellent quarter on multiple fronts, on virtually every front, be it serial growth or quarterly or year-over-year growth in terms of both revenue and profitability. Our financial metrics such as ROE speak for themselves. In this COVID world, the world is slowly returning to normalcy. It is evident that the new normal will include a greater reliance on technology, and therefore the outlook for the IT services industry is robust. I'd like to thank our team as well as their families for the resilience they've shown in this time where there was a complete invasion of the office into the home through 8 continuous months of work from home and still counting. We also thank our customers for their continued support and confidence. And with this, I'd like to hand this over to Venkat for more details.
Thank you, Ashok. Good morning. I would like to start by thanking Nomura Securities for hosting this call. I will in the next few minutes attempt to cover the highlights of our financial results for the third quarter of FY 2021. On the revenues, we grew our revenues in US dollar terms sequentially by 6% and year-over-year are at about 8.8% basis. Growth in 9 months over the previous year was about 2.2%. Revenue growth for the quarter in INR terms was 7.1% sequentially, 14.6% year-over-year basis, and on a 9-month over a 9-month period, it was 9.6%. So good growth numbers. Ebitda, we continue to maintain our upward trend. For Q3, I'm very happy to report an Ebitda of rupees 59.6 crores, which stands at about 29.7% of revenues. For the 9-month period, our Ebitda is a cumulative rupees 157 crores and 27.3% of our revenues. Improvement in Ebitda for the quarter over the previous has been largely contributed by increasing in operating revenues, some gains on accounts of foreign currency and other income, followed by high utilization of 81.6% and lower attrition of about 13.1%. All of us continue to work from home, and benefits from that, coupled with reduced travel and certain administrative costs, continue to help us. Our Ebitda numbers continue to be closer to that of larger IT companies while showing a growth higher than most of them. PBT for Q2 is rupees 53.3 crores and 26.5% of the revenues compared to rupees 42.7 crores and 22.7% in the previous quarter. PBT for 9 months is rupees 137 crores and 23.8% of revenues. As for PAT, for the quarter, it is rupees 42.15 crores and 20.9% of revenues compared to the rupees 34 crores and 18.1% we did in the last quarter. PAT for the 9-month period is 126 crores and at about 22% of our revenues. The above profit numbers translate to an EPS of rupees 8.91 per share for the 9-month period. That's a fully diluted EPS. Our balance sheet ratios of ROCE and ROE continue to be industry leading and very good at 36.2 and 33.2% respectively. We continue to generate strong cash flows. Coupled with full use of our working capital and beneficial borrowing facilities, our ratio of free cash flow generated to Ebitda continues to be 99%, and for the quarter we generated 59 crores. We ended the period with a cash and investment balance of rupees 540 crores approximately. Talking on a few other metrics, our DSO continues to be healthy. It's at about 80 days for the 9-month period. We added 6 new customers during the quarter. On our Happiest Minds, we are at 2,885 with a net addition of 164 Happiest Minds during the quarter. Continue with the policy of giving maximum disclosures. We have placed on our website a presentation to investors with detailed operational and financial metrics, including trends. Please do go through the same and get back with any questions you may have. With this, along with my colleagues on this call, I would like to open this session for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. The first question is from the line of Rishit Parikh from Nomura. Please go ahead.
Hi, thank you for this. 2 questions from my side. Right. The first, if I look at our employee expenses, they've been flattish in the last 3 quarters, right? Given that we've seen a rise in terms of demand for digital talent, could you let us know your thoughts, 1, on talent availability? Second, how do we plan to retain and attract talent? And also, if you could just comment on the wage hikes and the variable payouts that we plan to give out in the coming quarters. That's the first. And second, if I look at the growth in our largest geography, which is US, it is flattish from a QOQ standpoint. Could you just talk about what impacted growth and how should we think about growth in the coming quarters, especially in the US market?
All right. This is Nanda here, so I'd like to take this one. With respect to talent availability, let me tell you that we are seeing an uptick in demand also at this point of time, and we have been able to hire from the market as well as train people who we have hired, both cross-skill as well as up-skill, and with that we are able to meet our current demands. But with the upsurge in the demand that is coming in from a new business and existing business perspective, we will be going to the market and hiring on a big scale. And at the same time, our increase of fresh graduates also will see an uptick in the coming quarters. What was the second?
And anything wage hikes and variable payouts for the quarter, Nanda?
Yeah. Now coming to retention part, we have multiple activities going on, and we are right now going through an appraisal process, which will be followed by an increment effective April 1st. So with that, we will be able to retain most of our people. And our current attrition rates, let me also tell you, is at one of the lowest levels within the current industry. It stands today at about 12 to 13% at this point of time.
And this is Joseph here, and good observation on the U.S. market. We had a couple of engagements where we were delivering transformation programs for our customers in U.S. that came to an end in Q3, and a big chunk of the billing happened in Q2, and therefore If you look at US revenues, we were able to make up those, for the transformation projects that got over, and therefore the revenue stayed flat in US. But at the same time, we saw all the other geos show incremental growth. We have growth in Middle East through a couple of new customers we've added in the infrastructure and security space. In Europe, one of our large transformation projects was sort of peaking in Q3, so we see an increase in Europe numbers, and we also have a couple of new deals that we've signed that we've shared in the press release. And India as well, we had one of our larger customers where we had a milestone billing, which contributed to the increase in India percentage of revenue. And one of the larger customers in India in the infrastructure space, we continue to see good traction over there. Coming to US, we did see signs of demand picking up in December, and in January, once we came back from the holiday season, we've seen quite a few of our customers come back with new initiatives and budgets, and we expect the growth in US to pick up in Q4.
Yeah. Rishit, coming on to the employee costs and quarter on quarter, there has been an increase if you look at it from the last quarter. But what ends up happening is quite a bit of this has come through associates, partners, and subcontractors. And so that number goes into other expenses in the SEBI format of our results, which is why the employee expenses and benefits continue to remain constant over the quarter. That's one. The second is we are fully provided for all the variable pay and all of those expenses that have been incurred for the quarter. Any overachievement has also been provided for. Coming to the wage increase that we are looking, we would be doing that as per our internal policy. So there is a market survey that the People Factor is currently engaged in, and that will be something that will come to effect starting from April and July of next year.
Okay, fair enough. And just one follow-up, Joseph. Could you also provide some color on the TCV in the pipeline ending Q3? Do you see the $10-20 million deals in the pipeline yet, or I think there's still some time away? Thank you.
The pipeline, continues to be robust, and what we've also seen is that the pipeline is weighting more towards the higher probability. So we feel quite good about where our pipeline is right now.
And any comments on the TCV? Are we giving that number out as yet?
We don't share that number, Nishit.
Okay, fair enough. Thank you. I'll come back in the queue.
Thank you. The next question is from the line of Vimal Gohil from Union AMC. Please go ahead.
Yes, sir. Thank you for the opportunity, and congratulations on a very good set of numbers. Sir, my first question is on your Ebitda. You said that there is a certain forex and other income component in Ebitda. Could you just quantify that for me?
Yeah. The other income is about 6.6 crores, and forex income is about 1.85 crores. So if you look at it, we have put other income at about 898 lakhs in our SEBI results.
Okay, so apart from that, which is reported in the SEBI format, there is no other income component which is there in the Ebitda, right?
No, absolutely not.
Oh, okay. So second question, so I have two more questions. If you could just help me, give some outlook on your very recent acquisition of Concall Global Services. Two things over there. What is the kind of growth that this company has been doing, and whether the profitability of this company has been, after maybe at least in line with our company, or if it's not, what are the plans that we have to, sort of bring it up to the company average? Because clearly this is a large acquisition of about 10% of our revenue. So if at all the Ebitda is not maybe in line with our company average, we may see some sort of dilution in Ebitda. So if you could just comment on that. My second question will be, we have always maintained that our growth needs to be 2x of our peers in industry, and we benchmark ourselves with global companies like EPAM and Globant, which have been growing far higher as compared to Indian IT services companies. So do you maintain that we'll be able to grow 2x of our peers/industry in FY22? And because your peers have, most of them have guided for a double-digit sort of a growth in FY22. And lastly, just one data point I required. If you could just help me with absolute subcontracting cost for Q3 and 9 months of FY21. Thank you.
Yeah. So, Vimal, I think you have asked about 4 questions. If I lose track of any of them, I'll get back to you. The first is on the acquisition of PGS. We had put out a press release, an intimation to the stock exchange, which covered in detail the strategic intent of that acquisition. It gels well with our e-commerce digital capabilities that we are looking to build business around. And PGS has been a long-time customer of ours as well. And as we had put out, they do about $10 million in revenues, out of which we were billing them $2+ million. So there is a partnership that was in place, and that has then blossomed into this transaction. Coming to the growth, yes, being in the digital space, they will continue to grow fast, and they have been growing in the same path over the last few years. On profitability, it is not profit dilutive. It will be earnings accretive from the word go. The profit profile is very similar to what we have in our own business. So those 3 are with respect to the PGS acquisition. The second one that you talked about was the data point on subcontractor cost. I'll pick that out and I'll send it to you separately, or I'll during the call I'll give that number. What is the third question, Vimal?
Yeah. The growth. We maintained that the growth is expected to be 2x of our peers/industry.
Correct.
Most of our peers have talked about double-digit growth. So how should we look at it from an FY22 point of view?
Yeah. So we have long held that this current year of FY21 we would have a kind of tepid growth. During the IPO roadshow, that's what we had put out there, and we'll make it up in terms of profitability. Kept to that kind of a trend and that kind of a promise that we made. So to that extent, our growth is also slowly catching up, higher than what we said we would do earlier. But we had also said that going back to FY22, we'll be back to our past trajectory of 20+%, which is, if you look at it, twice that of industry peers in India.
Yes. Can I just add one small thing? When you mentioned that the acquisition is 10% of our sales, as Venkat has indicated to you, we were already billing some things into PGS. So it's not really 10%. It's smaller than that, to the extent that 2 million plus out of the 10 million we were already billing. But the profitability point is perfectly valid. If we combine both the profit that PGS was making and the profit we were making on their sales, then it's certainly not margin dilutive, and they're running at the same sort of profit levels that we are.
That is great to hear. So just one clarification. The 20% plus growth that you are expecting in 22, that will be including acquisitions or excluding the PGS acquisition?
I don't think we want to get into that detail. Our commitment on the long term is that we will do 20%, and I think let us say that there will be periods when part of it comes through small acquisitions, part of it may actually help to go above those levels, but I don't think we're getting into guidance at this stage. And remember one thing, that it's not, 1 quarter of those results will already be into this year, so it's not that it's adding an enormous amount to our revenues.
Fair enough, sir. Congratulations once again, and thank you.
Thanks, Vimal.
Thank you. The next question is from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. I just want to understand if you can provide some detail about sector-wise how you expect trend to play out. Because for last couple of quarters, what we have reported, we have seen some volatility. So if you can help us understand how one should look growth trajectory across sectors. So that would be helpful for medium-term perspective if you can provide some color, and what would be the growth driver. Second question is about margin. What would be the sustainable, let's say, considering our business profile and service offering, how one should look sustainable margin profile for Happiest Minds? Obviously, we are benefiting currently from some of the lower travel costs and other things, but what you think medium-term sustainable margin trajectory for us? And third thing is about deal win and pipeline. I think you earlier indicated we don't provide specific deal TCV win, but if you can provide some progress over last few months or maybe couple of quarters, how it has shaped up from qualitative perspective. Thank you.
Yeah. So, Dipesh, on the first part, I'm assuming that you're looking at the vertical split, and the question is related to that, right? So I would request Joseph to go ahead on that.
Yeah. So if you look at it, I'll take it both from a geo and vertical perspective, this question. So from a geo, as I mentioned earlier, we've seen new deals and pipeline build up in all our geos, including, some of the neo geos like Middle East and ANZ, Europe, which has been an area of, special focus for us. We've seen, we've reported a couple of new deals in Q3, and we're seeing, a healthy pipeline. And as I mentioned, US also has a good pipeline. So from a geo perspective, we think that, we'll have balanced growth in all our geos. From a vertical angle, I think the verticals that continue to where we continue to see traction, that we saw traction in Q3, were in the edutech, high-tech, digital media, and e-commerce space. And in media also, our focus is more on online and digital media, the new age media companies, or new age technology in media, and we've seen, COVID having a positive impact on them. After we came back from the holiday season in Jan, we've also seen an uptick in industrial and the logistics, the distribution space, where more of the digital initiatives have got budgeted and are being, implemented or executed, where we've seen existing and, some new.
Ladies and gentlemen, we lost the line of Mr. Nandaraju. I will just reconnect him back.
Yeah. So while we connect Joseph back, I'll just answer the question, the data point that was requested on the subcontractors. So Q2 we paid about, cost was about 14 crores. Q3 it was 18.6 crores. YTD it's about 48 crores. So that was on the subcontractor. So while that's out of the way, I'll get to Deepesh's question on the margin, sustainable margin numbers. So I've been holding on to the number with a range of between 21 to 23%. That's what I've been holding on as we go into the longer term, and things come back to normal with some of the cost benefits that we are today enjoying on account of the COVID pandemic and work from home situation coming back into P&L. So that's what I've been holding on. But yes, we have been performing much better than those numbers as we see from our financials. Margaret, do we have Joseph back on the line?
Yes, sir. We have him back in the call.
Venkat, yeah.
Yeah, sorry.
Yeah. So I think I was completing my response. The last point I was making is that we've seen, new initiatives being spun up in the industrial and logistics distribution space on the digital side. And so that's another area where we expect to, continue seeing traction.
Yeah. Let me rephrase the question. I think the third question is unanswered, deal win and pipeline. But let's say I rephrase on this sector-wise. Do you expect any change over 3-year period our revenue mix from vertical perspective, or you think this mix holds a largely stable kind of thing, and because we expect broad-based growth, and that's why mix unlikely to change in any meaningful way over next 3 years?
Let me intervene on this one. I don't think we're going to give you vertical data for 3 years or even what trends are happening. There are a lot of moving forces in the market. We are in high growth segments. We see all of them growing well. Sometimes what may happen is, for example, with this acquisition, obviously the proportion of retail business will go up. So there are so many imponderables, but basically speaking, if you ask me, we don't fundamentally on a sheer organic basis, I think all of them are in very high growth areas. We mentioned to you earlier that, we were not impacted by being present in places like travel, etc., in a large way, and we were in high areas which did not get impacted that much by the COVID epidemic, which is why you could see that our results have also held out better than most people's. So there is no dramatic change that you can expect if that is what you're looking for. Other than that, there will be incremental changes. It may be a function of one account growing faster than the other at our size can make a difference on one vertical versus the other. So let's just watch the space. But other than, I would say, growth in retail and e-commerce, because of the acquisition, I don't see that you're going to get a dramatic shift. and all of the segments that we're in will continue to grow.
We have said that we will be calling out healthcare as a vertical soon enough, Ashok, so that's something that we will change.
It's not even in our current list, so I don't think we want to tell them that. It will start appearing in the list as it begins to. We will from next year start reporting on it.
And, the last question, I just want to make 2 points on the pipeline. As I mentioned, the pipeline continues to be good. And from a qualitative angle, we've seen, deals move more into the advanced stage over Q3 and in the beginning, first 1.5 months of Q4.
Okay, thank you.
Thank you. The next question is from the line of Hardit Sangani from ICICI Securities. Please go ahead.
Thanks. Okay.
Sorry to interrupt you, Ms. Sangani. Your line is not very clear. Can you please check?
Hi, now is my voice audible?
Yes, now it is better. Thank you.
Yeah, sure. Thank you for giving me the opportunity to ask some questions. So it's a couple of questions, sir. So in terms of marketing cost, SG&A expenses specifically, so this quarter there has been a significant reduction as a percentage of revenue in those expenses. So just wanted to understand the rationale for it. Secondly, in terms of in terms of PGS, so do we plan to do acquisition of similar scale, or what specific areas are we looking to do the future acquisition? That's it from my side.
Yep. So the first question was the drop or the decrease in SG&A costs, right? Is that what it was, Hardik?
Yes, sir.
Yeah. So that's slightly a function of things like rental costs. The rental costs that we have been talking about, how those move. You got certain provisions for incentives or some provision for bad and doubtful debts that were created in the previous quarter versus that are no longer required in the current quarter. So majorly we look at it, the drop of about 4 or 5 crores in our detailed financials is on account of that. So otherwise we have held almost at the same or a similar or constant number compared to the last quarter. So that's on the SG&A part. As far as acquisitions are concerned, we are looking for, like we had earlier said, we're looking for profitable digital assets, which are in the range of, it can be anywhere upwards of $10 to $30 million is what we are looking at. And that was the basis on which we had also presented the need for strategic funds during the capital raise or fundraise that we did during the IPO, or retaining the cash balances on our books during the IPO.
And I might just add, you see the requirement in terms of targets is actually very broad. It could be geo-based. If we could get some things in geos which are, companies of a certain size where we don't have a very strong presence, that will help. And virtually in other areas where there's actually very, let's say, scarce high growth, and yet at the same time talent is very scarce. So we're really looking for capabilities when we do a acquisition. And anything that anybody on this call can help us with in terms of targets, we'd be most grateful.
Thank you, sir. Just a couple of more questions. So in the utilizations, it has peaked at around 81-82%. So as we go in extra industry revenue, so do we need to so will that utilization reduce as we will try to build up bench? And secondly, in terms of sales investment, so like we alluded that Europe and certain other markets to be the next growth engines for us. So will that market require significant sales investment to start with?
Okay, this is Nanda here. I'll take the question on the utilization front. Today we are around 80%, 80-83% in utilization, running at that number. And last 9 months it will be an averaging out about 78.5%. In our opinion, the range should be anywhere between 78 to 82, 83 kind of thing, and that will be maintaining that kind of utilization numbers going ahead.
So, this is Joseph here. And in terms of sales presence, we do have, I think, adequate sales presence in all our geos, including the newer geos. A couple of things that we'll be watching for. We're in the process of drawing up our plans, and depending on how we see the potential and account revenue movement in specific geos, we may add a little bit more bandwidth. The other area that we're looking at is in terms of senior account managers or client partners to really take some of our existing accounts to the next level, large accounts with potential to the next level. And that's an area where, we will probably add a few people so they can go about account mining and account expansion in a focused manner.
Okay. Thank you, Joseph. That's it from my side. I'll come back for follow-up.
Thank you. The next question is from the line of Vikas Yadav from Moonshot Ventures. Please go ahead.
Good morning, sir. Actually, my question is that in medium term we can think that we will be going for a software as a service kind of model?
So if I get a question right, will we be offering something as a software as a service?
Let me elaborate it further. We are having deep capability in edutech and all that. Can we use those capabilities in medium term for let's say 2 or 3 years, and then we try to make a new product out of it and give it a software as a service, and that kind of model we are thinking in that direction or not?
Let's really put that as a forward-looking question. Strategy keeps evolving. We already have a fairly high proportion of our revenue, as you know, which comes in terms of what we call as SaaS. So many things are moving into that model, but are we going to move into something where we would start competing with our customers? Not at all. So from that angle, you could rule it out, but we could deliver services all the time. Many of the solutions we are offering are on a SaaS basis. So that's not an issue, because that's the way the whole industry is moving. And therefore, we offer solutions in that format, but we don't get into competing with our customers. There can be other creative models which will emerge, but those will all be in the realm of forward-looking statements.
Okay, thank you.
Thank you. The next question is from the line of Harit Shah from Qtr3 Shares and Securities. Please go ahead.
Yes, thank you for the opportunity. So my first question, of course, is the acquisition that you made recently. So the journey, by when do you expect to consolidate it? Will it be the full fourth quarter, or will it be maybe sometime in between?
Yeah, Harit. So the definitive agreements were signed end of January, but we are in discussion with our auditors on the accounting for the consolidation of the subsidiary of the entity. So we are looking to see, because effective control is something that we need to go the basis for consolidation. So that's something under discussion. So the full consolidation for the full financial year will be available from next FY22, and for FY21 it could be for the last quarter.
Okay, so from 1st of January, you're saying that's a possibility?
That's a possibility.
Sure. Okay, my second question, so that's on the margin front. So you had mentioned that your 21 to 23%, I think, is the range that you are kind of comfortable with. So my question to that is, would you think that you are selling yourself short a bit there, given the performance that you've achieved so far this year, and also I think in context of the fact that the entire industry, I think almost all companies without exception have been able to record margin expansion this fiscal year, which is considerably above the maybe historical range of the last 2 to 3 years. So would you think that a possibility that you may definitely overachieve on this particular aspect, and maybe next year we may end up having to expect a better, higher range than what you're currently expecting?
Yeah, Harit. So like I mentioned on that margin front, we have been holding this number at 21-23% for the last 3-4 quarters. So right from the time we went for the book building or during the IPO. Things have been quite dynamic. Things have changed quite a bit. So your question does merit us to look at that profile and reconsider it, but which we'll surely look at when we get into the FY22 planning exercise. because I'm sure margin has got so many moving parts. We'll have to see how that plays out when we start a plan which is already in the works for FY22. Once we have that, I can tell you with a little bit more of conviction that it will be higher. Yes, I would like it to be higher because there are certain of these cost savings and elements of efficiency which have come in. We would like to retain as much as possible of those in the financials. That's something that we'll surely be focused on. So to answer your question, it's not that we're going to give up on margin expansion because we thought it's 21 to 23. Our sights are set higher.
Yeah, but I think we should be cautious about some of that because to the extent that the margin, everybody's margins went up with the rupee, clearly that will, get impacted for everybody. We have a much higher offshore content than other people, and therefore to that extent, we gain more and we may lose a little bit when things come back to normal and all the travel begins all over again. Immigration costs will begin all over again. But the way things have been, and I suppose that is where we could really take a look for the weighted average for the year. See, we're not getting back to work from office, and we're not really starting to travel in the way that obviously people have been doing, but at least I should imagine another 2 quarters. To that extent, you should say it should be sustainable, but I think there have been all the factors which caused it to expand. The moment they come into play, per contra, they'll also cause it to go down a little bit, which is fine. I mean, they're obviously running at a very high level. They're running at traditionally much higher levels than the IT industry has run for years. And I think it's actually healthier to go back because then you're attracting more, it really gives you an opportunity to become more competitive.
Sure, Ashok, that's quite helpful. And one last question from my side. So I realize you all don't obviously give out explicit volume and pricing kind of metrics, but just some sort of a back-ended calculation. The fact that your utilization rate has improved so substantially, so that does probably some sort of give an indication that possibly the pricing for this quarter was under pressure. So was that probably a right way to look at it? That this is entirely mainly volume led, and maybe this quarter pricing to some extent did see some sort of a decline? On a blended basis, that is.
Yeah. So Harit, to answer, there has been no pricing pressure to talk about this quarter. So that's one. Because if you have to move such a huge percentage, the price drop that you would expect has to be significant. So that's not happened. So it's largely utilization led. Obviously, when you look at our blend, like Joseph mentioned, we have made entry into Middle East. So the Middle East pricing will be slightly different compared to, let's say, the US pricing, given the costs related to that geography. I'm talking about on-site costs versus offshore. So other than that, there has been no change in prices.
Great. Okay, thanks, Venkat. That's helpful. That's it from my side.
Thank you.
Thank you. The next question from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Thank you for taking my question. So my question is pertaining to the edutech vertical mainly. Sir, just if you could give me your opinion, once things normalize post-COVID, what do you see the impact on this vertical? And I know you're not giving any quantitative outlook or guidance, but if you could give a qualitative view on your pipeline and capabilities in that segment. Thank you.
Sure. As you mentioned in the previous call as well, if you were there, one of the segments that we've seen a fair bit of activity and traction has been the edutech segment. With a few factors at play here. The chief among them is the move from school or in person to online, and what the segment is preparing for more of a hybrid kind of approach. And earlier they had some semblance of online learning that was there, but the scale that's required to have remote learning and some of the collaborative tools are very different, and they're realizing that. And so a lot of the initiatives that were kicked off in Q2 of last year or Q3 of the calendar year were in this direction. Once these companies the edutech companies took stock of the situation, and we see that continue to play out. Along with that, there's some of the newer elements around adaptive learning, predictive learning, usage of analytics to help with help students with making adjustments to their learning journey. All of these are coming into play, making it a much more interactive and immersive experience. So we expect that that these trends to continue for the foreseeable future.
Okay. Sure, sir. Thank you. Thank you for your answer.
Welcome.
Thank you. The next question is from the line of Qtr3 an individual investor. Please go ahead.
Hi. Compliments on the excellent results. I wanted to understand what is the percentage of travel expenses to the revenues, because this was the statement that has helped the company reduce the cost. So I wanted to sort of understand how much could it increase going forward.
Yeah. So to give you a high-level estimate, travel used to be about $500,000 a quarter, and that's $500,000 a quarter. That was the kind of run rate that we used to have. Now, if you're looking at it, that's come down to, I would not say zero, but close to that, because travel has two elements. One is travel and the visas. So the visa spend happens even now, given how we'll be filing the visas whenever the requirements are there. In anticipation of demand, we do file visas for the US. But otherwise, travel has largely come down.
Okay. The second question is, the percentage of people that you employ overseas versus India, do you see that changing in the aftermath of COVID? Because we hear companies talking about work from home more and more.
Yeah. So you're talking about on-site, offshore mix, right?
Yes. Yes.
There are some requirements which have to be necessarily done on-site, so which will be done, evaluated by the delivery team. So if the question is, are we pushing offshore when there is a mandated requirement of the customer for offshore or on-site, that's not the case. So it's largely customer and project driven. If there is a requirement for on-site people for understanding and fleshing out the project requirements or the requirements of a current job that we have at hand, we will deploy resources on-site. So right now, because of the travel restrictions, maybe people are not traveling, but we are doing local hiring to make sure that we are able to bring that work onto our books.
Question here, I think it's a little bit about asking for trends. Because there's a feeling that now that people have realized that you can work from home, maybe there won't be so much pressure for many of the companies who have people working on-site. Now, when you look at it, our ratio of offshore is the highest already in the industry. So therefore, we are not going to reduce that at all. Even if we remain at that level, I think it would be, from one angle, okay. But from the other angle, we do want a higher engagement in terms of more consulting-led sales, etc., in which we do quite well. So we could see marginal increases, not decreases, because suddenly the world has realized you could do everything else from on a work-from-home basis. So why do you need to be on-site?
Yeah. The other thing is the segmental revenue that that you showed in the investor presentation. Two segments had low shares, I think industrial and manufacturing, I think. So is that going to stay at those kind of percentages, or do you think that would also go up?
So if you really see in terms of, you want to take that, Rajiv? Go ahead, please.
No, so I think that as Joseph highlighted, Rajiv, Sridhar, so from industrial and manufacturing perspective, we see that area continue to grow, and especially with the newer business adoption that the customers have taken into, as well as digital investment they are making. And us as a company also continue to invest significantly on the domain side based on so I think that number will continue to improve and continue to see a growth from the kind of problems that we solve for the customer environment.
Yeah. Also, I'm not sure where you got that number, because manufacturing is actually showing a very solid growth in the current year.
It's about 7% and industrial is about 7%, I think. I don't recall the exact percentage, but both were below 10%.
Yes. Yeah, but manufacturing for us last year was 3.7, it's up to 6.5.
3.7.
Okay.
It's actually gone up very sharply.
Yeah. Okay. Yeah. Thank you.
Thank you. The next question is from the line of Vimal Gohil from Union AMC. And also we would like to remind our participants, you may press star and 1 to ask a question. Mr. Gohil, you may go ahead with your question, please.
Thank you so much for the opportunity once again, sir. Sir, sorry to prod you on margins again. Clearly, as there was a question asked that, you have clearly sort of, I don't want a guidance on the margin per se, but the drivers of margins. And the key drivers over here seem to be offshore and our utilization levels. And we've taken pride in stating that, we have one of the highest offshore rates in the industry. And clearly your global peers, EPAM and Global, have similar sort of metrics to report. Given the fact that, the work from home has forced us to, sort of look at different models, why would you want to change that? Because this is working perfectly all right. If the company has been able to sign large deals, from a work from home model, the company has been able to execute those. So my question is, why would Happiest Minds and the industry per se would want to change this if it's working so beautifully and it's giving growth plus it's profitable growth? That's my simple question, sir. Thank you.
Venkat, have you got this clear? I'm not sure what you're saying we are trying to change.
No.
We are also happy with the model, so we are not doing any fundamental changes here. But you're saying, so the question somehow went back to the issue on margin. Is that the one?
The question more so seems to be, Ashok, why not continue this work from home model even after things have settled down? Because everything seems to be working well for the company and for the industry, so why don't you adopt it as a kind of a permanent kind of a model?
If that is the question.
You get saving on the margins, Ashok, that's right.
That's right.
Yeah, but let me just tell you one thing. Firstly, it's not that our margins have gone up a lot because of work from home. We've saved rental costs because we don't own our premises. We travel in any case will come back when business comes back. The main thing about work from home, and you've got to really understand this, that there's much more to an organization than just people sitting isolated and working from home. It's the water cooler conversations, it's exchange of knowledge, it's people building the right culture. You could get into a completely non-bonded organization which loses sight of all our values which are very dear to us. And these are the really critical things which make us different. We would never contemplate on getting back to a model where we will say we will just continually work on home because you could do it and technology has demonstrated it. That we had already demonstrated from even before COVID. We'd always allowed our people up to 1 day a week to work from home. So, but the important thing is to be together, build teams, build culture, sustain that. And as soon as we can, we will then go back to, in a sense, being available in our own premises with all our people, all together and the teams working together.
Yeah, this is Ram. Just to add to what Ashok said, in the future also our customers may also say that, since the situation has become better, we may want to start again, the ODC kind of a culture and, they may ask us to return back to the work. That is one. Second aspect, apart from culture, which is extremely important, is that, there is a lot of whiteboarding, there is a lot of, brainstorming, there is a lot of other activities which is much more creative and it happens when we actually work from the office together. And that also has to happen. So we will see that, once the situation eases down, we'll get into more of a hybrid model where there will be work from home. It was always there, as Ashok mentioned, and also working from office. So it is going to help in building better camaraderie and also building better creativity.
Fair enough, sir. Sir, one more question would be, I think one more place where, the company has delivered well is controlling costs. And by cost, I mean the operating cost excluding the subcontractor cost. So that has clearly not grown in line with sales. And I think you had already mentioned that in the IPO. Kudos to the management for delivering on that. Just wanted to know if you're able to sort of grow at 20% plus growth rate in the longer run, will your costs also grow at the same pace? Is there a need to grow these costs at the same pace, or will you be able to sort of get more operating leverage from there?
So, Vimal, there are two components to cost. One is the people cost, which is the largest part of our business, and second is the SG&A. As far as SG&A is concerned,
costs that are excluding the people cost and the OPEX cost, the S&M, the G&A, etc.
So that's something that we have always been ahead of industry because of the smaller base that we had. We were maybe about a couple of percentage points ahead of industry, as far as, or even 2-3 percentage points ahead of the industry on the SG&A component of total costs. And we have always been saying that as we grow in size, that is something that will come down, and we were working on reducing that by about a percentage and a half every year. So that's been the trend over the last 2 years if you see our financials. And we continued that irrespective of COVID or not, pandemic or not, we have been focusing on that control. And that will come and it will stabilize at a number, somewhere between 9 and 11%, so that's something that it will stabilize at.
Yeah, but again, I want to caution, if I go back to my older days, between our SG&A costs as a mid-sized company, as well as the larger companies, there was a good 8% difference at all times because their volumes were so much larger. Now, we've already reduced that gap quite a bit. And the very fact that our profitability levels are comparable with the larger players, I won't say that we've got another lever which will take us above them. If you say, oh, you guys are almost equal to their level, now you think you can reduce your SG&A further by 3%, then you'll become more profitable with them. I don't think that will happen. Some other forces will come and balance out. We are happy enough remaining where we are in terms of relative profitability.
Understood, sir. Thank you so much.
I think we lost Ashok, but yeah. So, Vimal, I think you got the drift.
Yes, absolutely.
We're not going to take our eyes off that line item. But like Ashok was mentioning, there will be compensating levers which do pop up at some point in time, which may be an investment that needs to be made, and we will not hesitate to make that if that has a huge leverage on our revenues.
Understood, sir. Thank you so much for the detailed reply. Thank you very much.
Thank you.
Thank you. The next question from the line of Rishit Parekh from Nomura. Please go ahead.
Hi, thanks for taking the question again. Venkat, just one question on the acquisition, right? So while obviously it's a $10 million in terms of revenue run rate, is there likely to be a slow ramp up in the acquisition, and by when should we reach the 10 million from that particular entity? Is there a color that you can provide?
It is already a $10 million entity. Like I explained and Ashok also added, we were billing about $2 million into that company because it's a partnership that we've been having since 2018. So the net revenue that would come in at the time of consolidation would be 8. So while it's a 10 million independent entity, when you consolidate, we'll get about 8 million. And that's enough. As far as growth and profitability are concerned, they are in line with our company's numbers.
Okay. So what is the number of employees that we will be sort of taking on board as a part of this acquisition?
Other than us, we had another partner. So that partner has now rolled into us parts of those. We have not disclosed those numbers of employees, Rishit.
Okay, fair enough. And just, I think during the time of the IPO, we were talking about, let's say, investing in domain, investing in some of the newer capabilities from a talent, right? And adding some of the senior headcount in some of the geos that we wanted to sort of penetrate. Could you just provide a sense of where are we on that journey in general, and how's that shaping up, or is there a timeline that we are sort of looking at? I assume a good part of it will be evolving given the size of our company, but just in case anything that you would want to share.
Yeah, so I'll turn that over to Joseph and Rajiv because and Ram. Joseph.
Sure. So if you look at it from I'll take the business and US thing first. So one of the areas, as we had mentioned, is that we want to really beef up our domain capabilities and verticals. And so the last couple of months, we've started looking at vertical heads with deep domain capabilities for some of our verticals that we didn't have a head. And that search is in progress. As you would understand, finding good senior people is not that easy. So we're in the process of finding these people. At the same time, we're also looking at, how do we back them up with the mid-level domain talent, more of business analysts and consultants in India. On the technology side, we brought on board head for our automation. That's in Qtr3 for our DPA, digital process automation COE. We continue to invest in building some solution accelerators, building capabilities in some of the newer technologies, around blockchain, around artificial intelligence and analytics, automation. And so these are initiatives that are underway. Anything you want to add, Rajiv?
Yes, so just a couple of things, this is Rajiv, Rishit. So we had talked about earlier that we already had a retail CPG domain head in place, industrial manufacturing, and will continue to evolve as the model becomes more and more mature. And adding to what Joseph said, there is a significant set of, so apart from people to approach to the market, we continue to invest significantly in the newer technologies as well under our CTO organization. So looking at what are the newer technologies that are coming in along which helps us grow our domain-based approach in the marketplace. So the CTO organization is looking at that as well.
Okay, fair enough. Thank you.
Thank you. The next question is from the line of Pankaj Murarka from Renaissance Investments. Please go ahead.
Yeah, hi, morning, guys. I have one question, which is, given the stage of our evolution, we are about $100 million odd dollars in terms of our revenue size. And given the kind of opportunity landscape that we have and the kind of organization that we've built where we are focused on digital, to me, this 20% growth guidance sounds very conservative. My concern here is, given that you're a public listed company now, is and you have to meet shareholder expectations and achieve certain margin targets, is that forcing you to grossly underinvest into business?
No, we are certainly not underinvesting in growing in our business. Let's be clear, we are hell-bent in growing as fast as we can logically do. But you also got to understand, if the larger players are going to grow at 10% and we are saying we're going to grow at 20%, that seems like a logical type of a number to say. Now we do better than that, that's fantastic. But and though we are not even stating that as a specific guidance as of now, we are saying that that is our long-term trajectory that we expect to achieve for multiple years, actually, as we go through, because it will be at that level, it will still take us a fair number of years to become even what I'd say is a decent-sized, mid-sized upwards company. And we will continue that. So how things evolve as we go through, and let's also be honest about this. When you look at growth, it's also going to depend on what acquisition targets we land. We are not going to go after those targets just for the sake of growth. We have to get the right ones because there's nothing more critical to that in terms of, decision making. You have to make the right choices. You have to bring in the right new capabilities, and we'll be looking more for capability development than we'll be looking for size when we do those acquisitions. So I think these are some of the factors we have to keep in mind.
Ashok, I've seen you since Wipro days. Now, I just want you to step back for a moment and just think about it. Given the fact that we are at a point where digitization is only accelerating, we are on the cusp of it, and if anything, one thing that COVID has done is accelerated the whole journey where Fortune 500, 2,000 companies they are grossly underinvested in terms of digitizing their business. So the opportunity landscape is very significant. And just think about it, just step back for a moment, that what was the growth trajectory of Wipro when it was similar size? And do you think, are we still doing justice to our potential growth in that context?
Sure. So two things. One is that when Wipro was growing 60%, the market was growing 50%. So that's how we became the number 2 IT company. Now the market we're saying is growing 10%, we'll go 20%. So we're double of that. from that sheer angle, it seems to be fair enough. Now, are we doing, is there more potential? Is there something more that we would leverage as we go through? Will we be lucky with the right acquisitions? Would we certainly hope to do more? I would say answer to all of that is yes, but are we going to convert that into a guidance? No. We'll work towards seeing how we can do better internally, but this seems a very logical guidance, isn't it, to say we'll go double the growth rate of industry, and that we are saying we would achieve over a period of time, not just 1 or 2 years, but we hope to be able to sustain that.
Just one more point here. See, the industry growth doesn't apply to you because the industry includes legacy infrastructure, legacy services, which you are not into. The digital piece of the industry is growing at a much higher rate if you just look at digital component. And being such a small player, again, industry growth doesn't apply to you. So my last question on this is, I'm probably happy to chat offline in more detail. If I were to invert the question, and if let's say the board were to give you a mandate that you have to grow at a 40% CAGR, what would change in the business?
Yeah, so 2 things. One, I think you've got a valid point in your observation on the mix, and we make it all the time ourselves. But you must remember that a large amount of them have got, already up to 50-60% digital. That's one. 2, there is an inbuilt advantage for the larger guys. When people are moving from legacy to digital, quite often, instead of taking a complete de novo look and saying, hey, who's the party which can do us the best on this job, you will find that they will obviously look towards the existing partners and say, hey, can they do this for us? Which is why you see all of them have got very high retention rates in their growth from existing customers. So it is a challenge for us to get that part of the addressable market. It is there. I think we can do a better job, but it's not something which is available to us, like when we go to a customer which is really beginning their whole digital journey. So that's a very important point. The third point is that, we've always said that we are comparable with the EEG guys. And if you look at their growth rate also, they're projecting 20%. They're also a little larger. Not all of them are not much, much larger. It's not like the large Indian IT companies. But still, they're also projecting that 20%. Third thing is, if the board gave us a mandate, then frankly we'll tell the board that we want to be. See, we can always plan realistically, internally, or plan aggressive targets. But we've also got to be clear the basis on which we set our plans. I'll tell you, when you set out plans which are excessively stretched, we'd love to overachieve on a plan, but we'd rather not set up plans which become excessively stretched. It has all sorts of mental reactions within your own teams. Hey, we never achieved what we set out to do. So you build up a failure syndrome rather than a success syndrome, even though you've done much better than the rest of the industry. The second aspect is that it does have its own impact, one way or the other, on variable pay and stuff like that. We set a target, now you haven't achieved that target. Then you go to find workarounds to be able to satisfy your team. So there are many things that go into target for this thing. And setting numbers, fortunately our board won't ask us to do that, because they also realize the dynamics of all these things which I've just explained to you. It is not just a number, and it's not just say why should you not be growing faster. It is a function of what the organization sees as achievable, and perhaps a satisfaction of an overachievement versus an underachievement.
Sure. Thank you. My compliments to you, Ashok, for doing a phenomenal job in the third inning. Thank you.
Thank you so much.